Hello everyone, welcome to Global Online Platform. The students who are going to appear for the NTA UGC NET June 2024 exam from Management or Commerce session, Commerce subject. Today this session is going to be very much helpful for you. Today we are going to discuss the most important MCQs on Finance and Accounting. This is the part 1 of this unit. So after watching this video, you can easily target the good marks from finance and accounting, whichever will be questions, you will be easily tackle those questions and get the full marks. Okay, so the students who are going to appear for the NTA UGC NET June 2024 exam can take the advantage of the complete course on management. The new batch is starting from 13th May 2024. If you take this course, you will get daily live video lectures, complete syllabus notes will be provided, full syllabus mock test will be provided, 4000 MCQs will be provided, PYQs with explanation will be provided, and the biggest advantage of the course is if you take the paper 2 course, you will get paper 1 totally free. The fees for this course is 10,000, but after 20% discount you can get the course in 8,000 only. Paper 2 and paper 1 both are available in 8,000 only. So to join the Global Online app, you have to download. So if you face any difficulty, you can contact on the given number by WhatsApp. So first of all, download the Global Online app from Google Play Store. After downloading it, click on the store button. After clicking on the store button, type UGC NET Management in the search tab. Select the course, make the respective payment of the course. After making the payment, you can see all the content, access all the content of paper 1 as well as paper 2. Let's move to the question number 1. Statement 1. The value of the firm can be determined by dividing the earning before interest and taxes by overall cost of capital. Okay, VOF means value of firm can be determined by the formula earning before interest and taxes divided by overall cost of capital. So same thing is said in this statement. So this statement is totally correct. Let's see statement 2. Both the theories of capital structure given by the David Durand are not relevant in nature. First of all, try to understand the capital structure theories are classified into relevant theories as well as irrelevant theories. The irrelevant theories of the capital structure are net operating income approach as well as Modigliani-Miller approach. Then the relevant theories are basically the net income approach and traditional approach. Okay, so basically if you see that what he has said, David Durand has given two theories. One is the net operating net operating income, which is the irrelevant, and net income, which is relevant. And what he has said, not relevant in nature. Both theories given by David Durand are not irrelevant. One is relevant, another is irrelevant. So this statement will be what? Totally incorrect. So the right answer will be only statement 1 is correct. Let's move to second question. Which of the following is not the assumption of Walter approach to dividend valuation? Return on investment R and cost of equity KE are constant. The firm has perpetual life. External financing is encouraged and investment programs are financed both by debt and retained earning, and option number D is none of the above. So basically if you see what is has been asked, not the assumption from or related to what? Walter approach to dividend. So first one is will be not there. R and KE are constant. Then firm has perpetual life. This is also correct. None of the above. This not, because the right answer is option number C. External financing is not encouraged. Not word is not mentioned here. So that's why this statement got encouraged. They say this model is based on internal financing through retained earnings only. Okay, but here debt and retained earning as mentioned, the statement got incorrect. Option number C is the right answer. External financing is encouraged and investment programs are not financed both by debt and retained earning. This statement is totally incorrect. Now let's move to next question. Which of the following statement concerning the payback period is incorrect? Capital budgeting techniques. The payback period is basically simple to calculate and understand. Then the payback period measures the time that the project will take to generate enough cash flows to cover the initial investment. The payback period ignores the cash flows after the payback point has been reached, and it takes into account the time value of money. Basically, the capital budgeting techniques are classified into the traditional and modern techniques, or you can say discounted or non-discounted techniques. So basically here the payback period, you have to tell what statements are incorrect. So basically, first of all, the payback period is what is simple to calculate. Yes, payback period is related to what, कि भाई तुम्हारा पैसा कितने दिन में वापस आएगा. So this is related payback period is simple. It's simple. So option number C, 1 will not be right answer. B, if you check, payback period measures the time that the project will take to generate enough cash flows to cover the initial investment. Basically, the payback period is determined in years. Okay, payback period ignores the cash flows after the payback period flows have been reached. Means, suppose you have invested 1 lakh rupees and in 5 years by the cash flow of 20,000 per year, you received your money back. Then you will, whatever money will come in the 6th year, you will ignore them. So this statement is also correct. So 1, 2 and 3 will be neglected. Option number D is the right answer, because the time value does not, money is not considered in the payback period method, because the payback period is non-discounted technique or traditional technique. Option number D is the right answer. Let's move to question number 4. The following is which one of the following methods is discounted cash flow technique? Payback period, average rate of return, discount to sales ratio, and net present value. So what has been asked, which of the method is discounted cash flow? Discounted is totally where the present value factor is written. In other words, you can say it is asking about the modern technique. Payback is traditional, then average rate of return, it is also traditional. Discount to sales ratio is not any method in the payback period. The right answer will be option number D, net present value. Let's move to next question. Process of financial planning ends with preparation of the project statements, then preparation of the actual statements, then comparison of actual with projected, and ordering the employees that project figures on the same come true. So first of all, here the process of financial planning ends with, so first of all, what you will do, you will project the projected statement will be prepared, then actual statement will be prepared. So this both will not be the answer. Then you will order the employees that the projected figures whether they are coming or not. You will check this. Then you will, at last you will come the actual and projected, the comparison will be done. So option number C will be the right answer. The ending of the financial planning will be end with an comparison, or in another words you can say evaluation. Next question, statement 1. Sunk cost principle is followed under the capital budgeting and capital structure, and another statement is, during the capital budgeting process, valuation of project cannot be neglected. Evaluation of project cannot be neglected. Both statements are incorrect. Both statements are correct. Only statement 1 is correct. Only statement 2 is correct. So basically, statement 1 says sunk cost principle. Sunk cost principle is not the money which you have spent once on a project cannot be recovered. Okay, the cost which is not able, you are not able to recover, that cost is called as sunk cost. It is followed under both capital budgeting and capital structure. This is followed under capital budgeting only, not in case of capital structure. Okay, so basically this statement got incorrect. If you see the second statement, capital budgeting process, calculation, valuation of project cannot be neglected. So first, suppose you have A project, B project and C project. Before investing your money, because why, capital budgeting is related to long-term investment decision. So first of all, you have to invest the money in which project you should invest. You will have to properly do the evaluation by using the capital budgeting technique. So this statement is correct, but this statement is incorrect. So your right answer will be option number D. Only statement 2 is correct. This is an error bug. So option number D, let me give a second. Option number D will be the right answer for this question, not this B. Only statement 2 is correct, 1 is false. Why? Because capital structure is mentioned in this statement. Let's move to another statement based question. Present value factors are used in computing both the discounted payback period and average rate of return. Statement 2 says, while calculating the average rate of return, the time value of money is taken into consideration. This is not average, this is average. Okay, let's see what the statement, you have the options, both statements are incorrect, both statements are correct, only statement 1 is correct, only statement 2 is correct. Now let's see what the statements. Present value factors are also called as overall cost of capital in the capital betting. The present value factors are generally used in the both in discounted payback period. In the discounting method it is used, but what it is said, discounted payback period it will be used, but will not be used in the average rate of return. Why? Because average rate of return is a non-discounted technique, it is a traditional technique. In case of traditional technique, TVM is not considered. TVM stands for time value of money. So in case of discounted payback period it will be used, but in case of average rate of return it will not be used. So this statement got totally incorrect. If you check the statement 2, while calculating the average rate of return, time value of money is taken into consideration. This statement is also incorrect. Why? Because the because TVM is a average rate of return is a traditional concept, traditional technique. In case of traditional techniques, the time value of money is not taken into consideration. Okay, but it has said that time value of money is taken into consideration. That's why the statement got incorrect. Option number, the right answer for this question is option number A will be the right answer. Both statements are totally incorrect. Why? Because present value factor here due to average rate of return, and another the reason being the time value of money in case of average rate return. This has made the statements incorrect. Okay, option number A is the right answer. Now let's see which of the following is not applied in the capital betting. So cash flows calculated in investment is in incremental terms, then all cost and benefits are measured on cash basis, all accrued cost and revenues incorporated, and all benefits are measured on the after tax basis. So basically not applied in capital betting, you have to say cash flows are calculated on incremental basis. So this is totally correct. All cost and benefits are measured on cash basis. This is also correct because because we use generally the cash flow term. Then all benefits are measured on the after tax basis. This is also correct, but all accrued cost and revenues are incorporated. This statement is totally incorrect. So you have to say which one is not applied. So option number C, all accrued cost and revenues will not be incorporated. So the right answer in this question is option number C. Let's move to next question. Profitability index when applied to divisible projects impliedly assume that the project cannot be taken in parts, then NPV is linearly proportionate to part of the project taken up. NPV is additive in nature, and both B and C. Basically profitability index is also called as benefit cost ratio. So it is when applied to divisible projects, it implies it assumes that the project cannot be taken into parts. It is investing in a project is one time investment only. You cannot break the project and do your investment again and again. So option number A will not be there. So NPV linearly proportionate to part of the projects taken up, and NPV is additive in nature. So the both statement is option B and C are totally correct. Okay, so option number D will be the right answer, B and C. Now let's move to next question. Which of the following is not a capital budgeting decision? Expansion of program, merger, replacement of an asset, and inventory level. So if you are expanding your business, if you are expansion program, so this is a capital budgeting. If two companies are getting merged together, this is also a capital budgeting technique, because large amount of money will be invested and large amount will be investment, large sort of investment will be there. Replacement of assets. So suppose you have a land, but you want to replace your land or machinery. So this will also need large amount of money. So These three will be part of the capital betting technique, but inventory level is not associated with the capital betting technique. So option number D, inventory level, is the right answer. Which of the following is not true with reference to capital betting? So capital betting is related to asset replacement decisions. Cost of capital is equal to the minimum required return. Then existing investment in a project is not treated as a sunk cost, and timing of cash flows is relevant. Now let's see, capital betting is related to capital replacement decisions. So this statement is totally true. You have to tell what? You have to tell not true. Cost of capital is equal to minimum required rate of return. So this is also correct. So this will not be the answer. Existing investment in project is not treated as sunk cost. I have tell in the one of the previous question, it is treated as sunk cost. So this statement will be the right answer. And the timing of cash flow is relevant. So this statement will be also be not applicable. Option number C, existing investment in a project is not treated as sunk cost, will be the right answer. In capital betting, the term capital rationing implies means that no retained earnings available, that limited funds are available in investment, that no external funds can be raised, and that no fresh investment is required in the current year. So if you know about the term capital rationing, it is related with the limited funds. The company is having limited funds which it can use for use for investment. Okay, if a company want to invest in a project, in case the company has a limited funds, then the term used in this case is capital rationing. Okay, option number B will be the right answer. Which of the following is a risk factor in capital betting? Industry specific risk factor, competition risk factor, project specific risk factor, and all of the above. Okay, capital betting is a long term investment decision, so which is associated with the large type of project. So industrial factors can risk factor can be there. Competition based, if two companies are competing and one company wants to take any capital betting decision, they will have to see what the competitors are doing. So this is also applicable. Project risk, investing in a project is associated with risk. So this will also be there. So obviously our right answer will be your favorite option, option number D. All of the above will be the right answer. Next question.